Good morning and welcome to the ACTIVEOPS PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Executive Chairman Richard Jeffrey. Good morning to you.
Good morning and thank you, and welcome everyone to this half-year results from ACTIVEOPS. As usual, we try and make it as interesting and colourful for the business, but we do welcome questions as well. So do either put them online and or pick them up at the end as appropriate. We've got quite a strong message, I think, to convey today. The headlines are very good for the business, and there's a lot to be excited about. So in the course of the next sort of half an hour of actual delivery, as it were, Emma and I will talk through effectively the headlines of our positioning. We'll talk about the actual financial results, and I'll then finish up with our sort of fundamental strategy and some of the sort of ambition in the coming time. So off we go. I think what I want to start with today is highlighting the fact that just recently, and many people on the call may have actually attended, we did a Capital Markets Day, and that was something about really unlocking the full aspiration of ACTIVEOPS. This is not something we've done before, but in that day we put out our sense now of where we're heading as an organisation, and that's in financial terms heading towards the achieving 100 million of ARR and a 25% EBITDA company. And for reasons I can go into, but there's much more available on the investor website on that day, we think that's a kind of logical progression of where we are. So the whole underpinning of the sort of velocity of that is reflected in our half year results, which we'll spend more time on today. So for those of you who are unfamiliar with ACTIVEOPS, I'll spend a bit of time just explaining where we fit in the sort of ecosystem of SaaS software. Our customers are large banks, insurance companies, or other organizations with lots of administration, and by consequence, lots of different things their people are doing in different teams, different products, different functions. Banks, insurance companies with thousands of people, but thousands of people doing different things in different teams. And they have systems that, again, you may have heard of, like workflow tools such as Appian or Salesforce, and systems of record of people like Workday or People and SuccessFactors. And those are kind of different universes where you have the work going on and you have the people doing the doing. And ACTIVEOPS sits at the intersection of those two types of organization, two types of computer software, where organizations need to stitch it all together to say how much time have people got, how much work can be done, and whether it's a team leader this week, next week, or a departmental, or indeed the strategic operation of the business in terms of how they configure the business, what the future looks like. And really that's the sort of secret sauce of ACTIVEOPS. We give people control. We give them visibility of the data, but we process it and we present it in a form that supports that decision intelligence that they so critically need. Now, the interesting thing for ACTIVEOPS right now is that's becoming more of a sort of companies are becoming more self-aware. The impact for us of AI, of robotic process automation, process mining, these are all labels that our customers are wrestling with and trying to implement value from, is making their world more complicated to run. And that speaks directly to the tooling and the support ACTIVEOPS provides. So with our support, with our technologies, organizations are not only able to perform better, but they're also more able to exploit and be certain about those really expensive investments they're also making in their own transformation. So ACTIVEOPS is that fundamental control tool to accelerate and augment their business transformation, which is, as you can imagine right now, with all the sort of a need for agility and customer expectation, a big issue for a lot of our customers. Now, in terms of an organization, we think we have a number of sort of key strengths, and some of those are on the slides there. At a financial level, ACTIVEOPS is a really simple business. We sell SaaS software. It's billed annually in advance based on our user base. And that gives, and Emma will come back to this, a really nice financial model where the business can grow out of its own cash. It's 90% gross margin, and fundamentally it's also rolls over. So as we go into any given year, typically about 90% of our forthcoming revenues are already essentially sold. And in each year, we're just adding to that as we sell new customers, we do new implementations, and that rolls through. So it's a very, very secure and sound business model. We sit at a very interesting space, as I've described, and it's an area which we're quite differentiated in, particularly with the new acquisition this year, which I'll come on to. We probably represent the leading authorities in this space. There is, to our experience, no other organization has focused on that particular world of workforce optimization in the complex world of back office anywhere on the planet. And we operate now globally, and that's seen in and the sort of success and the truth of that is seen in the fact that we have customers in Australia, in South Africa, in Canada, and all over the world who use our stuff to leverage and solve this particular complicated problem. The very nature of our business means our customers are blue chip. All sorts of implications of that makes sales larger, probably more protracted, but also in our history, I think, Emma, technically we've never actually had a bad debt. So we operate to a very, very sort of secure audience in that respect. But then coming to the sort of forward look of the business, and it comes in a key stat for which is net revenue retention. We have huge expansion potential in our existing customer base. So although we're now hitting around the 40 million of annual recurrent revenue, we can see at least 130 million of accessible revenue from customers to whom we've already sold to. So think about that. There's no sales cost in terms of new customer acquisition. If we just keep that NRR, net revenue retention, so we're growing every year, there's 130 million of accessible ARR for us to sell to. Now, of course, we're not just doing that because we're selling to new customers who see the need for our stuff. And we've had our best best year ever last year, and the pace of that new customer acquisition is continuing to grow this year. So the expanding opportunity is very large for the business. And the business has been on a path. In many ways, the half-year results is just the start of what we think is the consequence of some sort of sequence of investments we've been making. About 6 years ago, we completely replatformed our technology, which has now been fully deployed on our customer base. So we're now deploying better and better product at incremental revenue. Our series are generating more revenue because we're offering more value to our customers. And that is, if you like, creating this huge momentum to accelerate growth. And our next phase is really to sell more of what we've got. So we've made some strategic investments in our sales capacity in the course of the last year, which is genuinely, is leading some significant results as seen through the figures. So from our point of view, an awful lot of a very healthy momentum. But just to bring that to life a little bit, there's a slide here on the screen which just tells a story about one particular customer. This is CIBC Mellon, which is a trade, there's sort of a joint venture in Canada that handles fund investment accounting for CIBC and BNY Mellon, two of the largest banks. Well, BNY Mellon's one of the biggest custodians on the planet. CIBC is a huge Canadian bank. And it's a classic example where a lot of people spending a lot of days trying to do that daily fund accounting, reflecting people's investment values, which operates to a very tight cycle and with an awful lot of data. And an incoming manager found it was very hard to run. They had very little visibility over work requirements, skills, but also just productivity, performance. And they knew they wanted to grow, they needed to expand their product set, but no real operational data on which to make that kind of decisions about where to put people and how to grow the business. And ActiveOps has comprehensively solved that. Catherine Tusher, who was a keynote at our conferences this year, one of our conferences, was the COO there, and she will tell you all through the stats that are here how it's enabled the business to accelerate in all sorts of ways. The sense of safety and control of the operational staff from being in a better managed environment where they knew what they had to do and they could feel successful, but also from her perspective, her ability to flex the business, and just as an example, open up another centre in Vancouver to look after, to give advantage of a 3-hour time shift between Toronto. It's just a brilliant example of how strategic, operationally and tactically they are enhanced by having the value of ActiveOps systems in place. Really great little story, and there's lots more on our website about equal stories like that. So that's the type of experience customers have by introducing ActiveOps software and the methodology for managing operations that comes with it. So then let's just move on to the actual results for the half year, which Emma will come on to the detail of. But from my point of view as the executive chairman, it really feels like a business which is humming. The core growth engine is delivering new sales. So we've had 5 in the half year, and we've already had another 3 in subsequent to September. And compare that to last year, where we had 9 in total over the full year, and 9 itself was 3 times the rate of the previous year. So the new customer acquisition is really going well, and speaking to both the product set we have and the market demand. But the other side of this business is that net revenue retention. Our software, if it does its job, actually reduces the number of people need. It improves the efficiency of the business. So we're not doing our job, and we do, if we don't enable that acceleration in productivity. But if you like, naturally, the business is its heads, which we would using our software. But on top of that, with our product, our net revenue retention last year was 116%. So for every single dollar of revenue last year, we're getting 116 cents on the for the current year. I mean, that's phenomenal, and it's phenomenal in any SaaS context. So we're very excited about that, because it's the manifestation of the product investments we've been making over the last few years. So if you compound that going into each year, where you'll get 16% growth in the book each year, plus of course we're adding in our new customers each year, you begin to see why we think why we came out with the path to 100 million ARR business is pretty clear for us right now. The other facet of our confidence is coming from our expanding target addressable market. ActiveOps has been very focused on a certain type of work, the sort of complex administrative work. But of course, organizations have a lot of people doing a lot of things. And what we're doing in our decision intelligence suite with the product is extending that. So in a typical bank now, we can offer a suite of software which is not just in the administration, but it's in the branches, it's in the relationship directors, in relationship managers. There's people more customer facing. So we're actually significantly enhancing the addressable community within that customer community, and of course to our other potential customers. And the final component of our success this year, I think, is the acquisition of Enlighten. So Enlighten was a very similar company in a sense. It was a very ops centric, probably more consulting led, but a consulting with a tool attached organization. We've worked, again them and in Australia in particular over many years, and we were delighted to have the opportunity to acquire them this year, because with that comes firstly a body of knowledge and experience which incredibly augments our own. Secondly, it extends our regional strength. So we are by now the completely dominant player in Australia, but also it's introduced us and brought with it some really new 22 new customers, of which 6 or 7 are very large enterprise organizations, which we will enhance our presence in the US, but probably more significantly gives us a huge amount of additional sort of a target addressable that we can go at. So that revenue, which of course we can leverage the infrastructure, because we don't need 2 management teams, we don't need new our development centers. There's a whole load of associated cost efficiencies which we can bring on top of what was a 8.5 million of additional annual recurrent revenue coming to the books. So a very, very good, and we'll come to some details, but fundamentally we're just as excited about having made the deal in here we sit in November as we were when we did it back at the end of July, which is not always the case. I think the final word for me is then about that line along the bottom. This isn't a kind of regional regional pulse. What you can see there is all the different regions of business in various ways have had a very good half year. South Africa is a very high percentage. It all depends on the base, of course, but SA is a great strength, but then other regions are much larger, so a percentage increase is in that sense slightly harder to achieve. But the key thing, this is a very global group with a lot of global success. So that's the sort of headlines. Emma, perhaps I'll hand over to you to pick up some of the actual numbers.
Well, super. Thank you very much, Richard. So we've had a very strong start to FY26. Even without the value add acquisition of Enlighten, our underlying metrics are solid for the first half of the year. It is worth just highlighting that the numbers that we're presenting for H1 only include 3 months of the financial performance of Enlighten as opposed to 6 months. We acquired the business on the 27th of June, so for the H2 you'll see a full 6 months of trade included in the H2 numbers. In terms of the financial highlights to share with you, so our organic SaaS revenue growth, apologies about the light, Our SaaS revenue growth increased by 22% year on year, which is supported by the acquisition of new logos that we've had in the year and also the underlying NRR rates, which I'll come on to shortly. We've reported just under 41 million of ARR at the end of H1, of which includes 8.1 million coming directly from the recent acquisition of Enlighten. Even if you strip out the impact of the acquisition of Enlighten, we are still reporting an organic ARR year-on-year growth rate of 27%. From an adjusted EBITDA margin point of view, we've reported 9%. For the same period last year, we reported 7%. And that's despite the investment that we've done in our sales and marketing in the first half of this year. And then finally, the cash position. So we've reported a cash position of 13.3 million versus the previous year, it's 13.4, so it's broadly in line. However, that is despite the fact that during the first half of this year, we've paid out £5.8 million of cash for the initial acquisition, the initial consideration payment for Enlighten. One of the other things to highlight on here is the T&I revenue recognition. So consistently over the last few halves, we've reported 1.3 million versus the first half of this year where we've reported 3.4 million. That is a 145% increase on a constant currency basis, on an organic basis. One of the main drivers behind this is the new logo acquisition that Richard has already spoken to. So last year we onboarded 9 new customers, and so far this financial year, in the first half of the year, we've onboarded 5. So you're really starting to see that momentum pull through, which ultimately drives the professional services revenue for us. What we're typically going to see is return to normal levels. So if you look at the pre-COVID professional services revenue levels, we are currently on track to return to those previous historic levels compared to what we've seen in the last few years. In terms of some of the other P&L performance metrics, so from a gross margin, we've maintained an 84% gross margin. We've delivered that rate consistently for the last few years. You do see a little bit of mix on the gross margin, so you do have a mix between a SaaS margin and a T&I margin. Our SaaS margin for the first half of the year was 90%, which was a slight improvement that we saw in the first half of the previous year, which is driven by some restructuring within the server hosting environment to make that even more commercially additive to us. From a T&I margin perspective, these do fluctuate depending on whether we're installing to an existing customer or a new logo. The margins typically that you'd expect to see for T&I margins for us is anywhere between 50 and 60%. The operating cost, you'll see that it's gone from 11.1 to 15.6 million, which is a huge increase, but actually that is mainly driven by the consolidation of the Enlighten OpEx. And then also the sales investment that we've previously mentioned. We're talking a lot on here about adjusted PBT and adjusted EPS. The reason why we've put the numbers on here as adjusted is we've removed the impact of the deal fees relating to the acquisition of Enlighten. So we did incur £1.4 million of deal fees in the first half of the year, so the EPS and the PBT numbers shown on this screen have excluded that. We've seen an increase in the adjusted EBITDA, so we went from 1 million for the first half last year to 2 million, so we've doubled the adjusted EBITDA performance in the first half of the year. One of the things that we've talked about for a number of years is around starting to see the operational leverage come through from our business model. And we are really starting to see that. So if you look at what the incremental revenue is half year on half year, and then compare that as a margin against the increase in the EBITDA that we've performed in the first half of the year, every pound of new revenue coming through is worth more to us than what we've previously had. So the adjusted EBITDA margin on new revenue coming through is 15% versus the combined average group, which is 9%. So you really start to see that leverage come through in the business model. In terms of the strength of the SaaS model, so one of the things we've done here is that chart in the middle is what we've done is we've split out where the growth of the ARR is coming from. So we're talking about, we're seeing a 27% increase in ARR year on year on an organic constant currency basis. So what we're seeing here is the impact of the new logo momentum really pulling through. So of that 27%, 11% has come from new logo ARR growth, which comes from the new logos that we won in the back half of last year, plus the 5 that we've secured already this financial year. But also the other number on here, which is impressive, is the NRR rate. So on a constant currency basis, we're reporting 116% NRR, which very much talks to the expansion that we've done within the existing accounts, but also the upsell of the series, which I'll come on to shortly in a second. One of the things that we talk about, so if I just continue on the theme of the NRR, so what really supported by the NRR rate is the customer expansion that we see within our existing portfolio. So for some of you that have followed us for a while, you will have seen a similar chart to this before. So we shared a UK Tier 1 bank last year. This year we're sharing a African Tier 1 bank. This particular customer has been with us for over 10 years. However, just for presentation purposes, we've just included the last 7 years on here. And this is quite typical for what we see. So quite often we will go into a new logo and we'll go into a particular division to try and solve a particular problem. What we then often will do is, from the return on investment that that particular division sees, is very quickly we will scale through the organisation, and that is exactly what's happened here. So in FY23, we went into a new area, which was the central ops service within this particular bank. And then in FY24, they continued to expand their user base, but also they moved across to Series 3. So just to give you a bit of flavour on that, so Control IQ, our core product, our cornerstone product, is split into series. So every time that we do a bundle of new releases of new features, we will basically call that series and we will commercialise that. So with this particular bank, they moved to Series 3, which actually to us increased their ARR by 150%. The following year, we actually then upsold them to Series 4, which increased their ARR by a further 50%. And then more recently, we've been able to cross-sell Work IQ, which then has increased their ARR by a further 67%. One of the really interesting things is within the series that we have a number of customers that are still on Series 2.5. So we've got 35 customers still on Series 2.5, which gives us a great opportunity to continue that acceleration and that ARR growth. We've also got 26 customers on Series 3. And just more recently, we released Series 4 at the start of this calendar year, and we've got 11 customers on that series at the moment. So there's a huge expansion potential within our existing customer base, even just within the Control IQ series releases. Then that's not to mention the cross-sell opportunity with Casework IQ, and then also the expansion of Work IQ. Okay, so in terms of the TAM and the achievable total addressable markets that we have ahead of us, so what we've got on here is the achievable TAM, and what do we mean by that? So as an organisation at the end of September, our ARR was just under £41 million. If you look at the existing customer base that we have today, and we look at the series uplift, the cross-sell opportunities that we have, we believe that we could grow the ARR within the existing customer base by 130 million. If you then also look into our target top 250 accounts, we can increase that ARR again by 900 million. So one of the things that's worth highlighting is that with the 41 million that we have today, we're actually only addressing 4% of the immediately achievable TAM that we have ahead of us. If you actually looked across the sectors in which we operate in, beyond the target 250 accounts, we're actually addressing less than 1% of the available market that we have. So there's a huge opportunity to continue, number one, pushing that NRR. The rates that we've seen recently continue to deliver similar rates that we've seen in the last year. But then also there's a huge opportunity to onboard new logos, which is what we're really seeing that momentum come through at the moment. Just to quickly touch on the Enlighten integration. So when we initially acquired Enlighten, we shared with the market our plan of an 18-month integration plan, which we are well into. So we're 5 months into that 18-month integration plan. The one thing I can say is we're currently on track to deliver that 18-month integration plan, and the cost synergies that we'd identified at the point of the acquisition, we're in the process of executing and we are realising as we work through that process at the moment. We have combined the operational activity of the Enlighten organisation within our own ops structure already. And then the other thing really to highlight is we talked around the acquisition being EPS accretive from FY27, which we're very much on track to still deliver. It is worth pointing at this point, the initial consideration for Enlighten we funded through our own cash reserves, so we didn't bring on any debt as part of that acquisition, and the balance sheet still remains strong despite the acquisition. So just from a capital allocation perspective, so in terms of our order prioritisation, so as an organisation, we remain an organic growth business as our first priority. So we will continue to invest in our sales and marketing. We'll continue to invest in the partner channel, which we've just started on that journey very recently, and we'll continue to invest in our product as well. We will continue to look for M&A opportunities, provided that it's the right opportunity for the organisation. And then finally, as the third in order of prioritisation, we would look to return any additional funds available back to shareholders as and when appropriate. So then finally, just a few takeaways from me. So firstly, we do expect to remain a double-digit ARR growth business for FY26 and beyond. We do have a clear strategy to drive growth within the organisation. There's a huge opportunity ahead of us, and then also to continue driving the operational leverage within the business. We still have a very strong balance sheet. We have no debt. We are highly cash generative. And then finally, as Richard's already mentioned, our ambition to become a 100 million ARR business in the medium term is absolutely achievable. We believe it is achievable and is what we are currently working towards.
Very good. Thanks, Emma. So just moving on then, in terms of some more substance about that, how the growth sort of strategy. I think if there's one anchoring point I want to make is that this is essentially about continuing to improve on things we're already doing. So this isn't about a sort of magic left turn or a big pivot. We have a powerful product which people are buying quite well, and as such the agenda is moving from, if you like, product development and effectively pitch marketing to much more about the selling. And to that extent, what we have is a proven engine. We're just going to scale it. He says just, but there's so much about that. It's resilient. What do I mean by resilient? We're global. So we're not subject to the vagaries of individual, if you like, regional economies go up and down. And what we've seen over the years, the value of currency spread. So in other words, because we have Australian dollars, we have New Zealand currency, we have US, we have Canadian, and all coming back to the UK, that makes the business also very, very resilient. There's lots of aspects of our business model, which means we can tactically deploy sales in particular regions to, if you like, capture opportunities. The NRR, I know we've mentioned that a lot, but you really can't underestimate that, the value of that core growth engine where your existing customers are buying more from you at the level they currently are. That's a huge growth lever for us. And because what we've done in this year, we've increased our sales capacity. So as of September this year, we had 16 quota carriers, and that would have compared with April the prior year of just 8. So imagine that working through the system, becoming ramped, different vagaries of different sales in different areas, as you can imagine. But fundamentally, the sales capacity of this organization is very, very different from what it would have been a year ago. But also to augment that and to focus it, I've just appointed Stephen Teasdale as our new Chief Revenue Officer. And his role, because we operate quite a globally diverse model, is to pull that sales structure into a coherent proposition and give us the platform from which to scale. So that as we hire the next tranche of 5, 6, who knows, sales teams, they're stepping into a well-structured, well-disciplined environment. Ditto expansion about existing customers, the importance of account management, as you can imagine, and identifying what part of the organizations would value from ActiveOps' software is a critical part of expansion selling. So Stephen's come in to augment our capabilities in that area. And of course, underneath all that, the value of our IP, the value of our intellectual property. We have 15 years of operating underpinning our AI tools now. And that's our kind of uniqueness. We can bring some specific capabilities at the desktop that others just can't do. That's part of our moat, if you like. And of course, we're simplifying how we make our products work in terms of for our customers. Instead of a team leader or operational leader looking at a set of numbers, however well structured, they can now tap a query into this ActiveOps software and say, what should I worry about? And it'll come up with a considered view of all the different things that they might want to give their attention to. So lots and lots of really interesting capabilities on which to sell that platform. So that is the anchor of our growth, is doing what we do better and at larger scale, but it's what we already do. And just by way of example, some of the tooling that's now in beta for our customers, I won't go into much, and again, much more on the website if you want to hear more information, but it's a combination of really practical stuff at the coalface to help organizations simply exploit and do better with what today. That would be a productivity boost with being tested with our customers. But we're also going into different domains like case analysis and process mining is a huge issue for our customers, and we're providing tools to do that just as a byproduct of using our software, rather than having to get extra software or additional experts or consultancies in to do it. Right through to one of the most troublesome issue for organizations is benefit measurement as they deploy technology, and we're giving them a transformation tracker as a tool, so they can essentially scorekeep themselves, not just within operations but across the whole enterprise as they deploy and they manage different tools. So that makes ActiveOps the kind of meter of value of those projects and processes they're looking to change, which in a world of so much moving parts is data beyond it's worth a lot, let's put it that way. So lots of exciting things to talk about. The other thing that I think is really notable in terms of the last half is just the level of interest. We've always taken a pride in networking our customers and building this community around professionalizing operations management. And there's some stats on the screen there. We have our customer events, one in Toronto, one in Melbourne, and in London. And this year we were exceptionally pleased with the turnout. Huge number of customers, and also a huge number of potential customers who, frankly, coming to our events gives them a sort of it very much an experience they realize they want to be part of. Very powerful as a business accelerator tool. But also this particular year, I think almost all the Enlighten customers came to capacity events. And that's really had its impact in terms of them seeing that becoming part of the ActiveOps community is going to augment and add a huge amount of value. So we're already seeing cross-selling opportunities and accelerated demand to move on to the ActiveOps platform from the Enlighten customers, which again will help to improve the pace at which we can achieve operational gearing. It'll help expand the target addressable market, because some of those customers are really quite large as well. So an awful lot from our sort of infrastructure, that, again, which is just driving extra value but at very little incremental cost. The second pillar, though, beyond the sort of doing what we do better and larger, is now starting to focus around different ways of going to market through channels. ActiveOps has a relationship with many organizations because of the nature of who we work with, but we've recruited a head of group partnering, because we see there's a huge opportunity to take our product to work with some of those other big institutional systems like Workday, like ServiceNow. So we're not, rather than going direct to those core system owners and their own ecosystem, we're working with the partners, the people who have responsibility to, and a business model that requires selling more software to those infrastructures. The example at the moment is a healthy relationship building with a company called Rulesware in the US, which is a very big Pega partner, Pega being a workflow tool, where we are working with them to deploy ActiveOps in the environments that they have with their customers, but also develop a kind of niche product fit to that specific environment, which we can only do with their help. Because we see that opportunity for us is in terms of business development, where those environments, those software platforms have particular features which we can sell to. So I think our partner strategy is something that we'll be working on in the course of this year. I think by the end of this year, we'll have a very clear view and some prototypes working, like the Rulesware relationship. But I hope within 3 years, we'll be looking at the introductions and the co-sales from our partner network being incredibly accretive and additive to what's truly fundamentally an organic direct sales growth engine. So it all adds together to really a hugely positive outlook for this business. It does feel like a number of threads are coming together. We have had in terms of the outlook, the second half is continued in the same vein. So, lots of things to talk about in due course at next results show. We're pretty confident to be reporting positive things. But fundamentally, we've already had 3 new customers after the half year. So that's 8 cumulatively for the year. As Emma said, the Enlighten acquisition is bedding in nicely, with absolutely confidence around the cost savings, but also the capability enhancement, I think, that we're looking for. And that the impact of the investments in those the sales structures and the like really starting to kick through. So overall, that adds up with a management team that's feeling confident about the outlook, but also returning to that 100 million ARR theme. That's of course it's not going to be easy, and it's not. But it feels like a logical progression of the rate of velocity of this business right now, rather than a sort of moonshot, big hairy goal activity. So a lot that we are have to work on. But as ever, it's an interesting space, and we're as excited about it as we ever are. So that's the presentation deck, but I see a few questions have popped up on the Q&A here. So
do you want me to jump in with one on deferred income?
You go for it.
Okay, perfect. So there's a question around the deferred income fell from 16.7 to 13.9. The main driver behind this is the timing of invoicing. So the first half, most of our renewals take place in the second half of the year. So actually the highest peak for us on deferred income is in H2. So if you look over history, you will see that at the end of H1, there is a natural dip in deferred income. So it is not a signal of slowing billing momentum.
From James, how much of the casework ARR came from cross-selling rather than new logos, and can this pace continue? I think to answer the last bit first, yes, definitely. But interestingly, most of the casework is expansion. So it's customers who absolutely know the value of ActiveOps, but the value of the casework product to extend it to a more complex type of work. Interestingly, though, almost all the new logos took a blend. So from the get-go, there was both the Control IQ and the Casework IQ. So I don't think we've had a single pure play new casework sale. I might check myself on that one, but to the point, it's certainly complementing the portfolio, and it's a very big expansion lever. Should we expect further mergers and acquisitions to drive the next phase of growth, or has the strategy shifted to purely organic? No, I think what we're saying there is ActiveOps has the capacity to achieve its targets through organic growth, but as the Enlighten acquisition, I think, is demonstrating, it's a very useful accelerator, both in terms of client prospects and also just fundamental revenues. So it absolutely is part of our activity, and in fact, with the return of our share price to what you might certainly in excess of where we floated, of course, that gives us greater access to capital and the potential of doing M&As through that raise, which some of you may know the history, but shortly after we floated, we had an opportunity, but with the market context, we weren't able to do the deal, which is frustrating at the time. But I think that's in a much better place today. So no, we will absolutely do selective acquisitions if the opportunity is there, and we have a very clear sort of set of criteria against which we would be doing that.
In terms of the time frame attached to 100 million ARR, so we haven't gone out with sort of a deadline or a time frame as such. What we have said on that is in the medium term. Which what do we mean by that? So it's anywhere between sort of 3 to 5 years is currently the goal.
Market speak for that sort of time frame, isn't it?
Yeah.
And outside of share buyback, any thoughts on potential timing or financial achievements to trigger a shareholder dividend? Yeah, I mean, it is third on the list of capital allocation. This is primarily a growth stock, and I think for most of the people who've invested in the stock, it's a growth, it's a growth agenda. However, there is an element of sort of financial maturity around dividend, and as a significant, as a founder and as a shareholder myself, that is a factor to consider. But fundamentally, with the level of opportunity we see in front of us, I think it's a growth investment. We would invest for growth. We'll take that under advisement. I mean, at the moment, I think the answer is not. We just recognise that there is potential for that. Should the cash pile grow, and we haven't got the other obvious opportunities in terms of M&A, and for EBITDA reasons, we want to maintain our profitability and so on, you get to that place that share buybacks or possibly dividends, will become the logical next step.
That's great, Richard. Emma, if I may just jump back in there, and thank you for addressing all those questions from investors today. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. But Richard, before I redirect investors to provide you with their feedback, which is particularly important to the company, could I please just ask you for a few closing comments?
Thank you. ActiveOps is on a really strong roll. We've got a fantastic NRR. We've got a growing client base that's a new customer client base, and so, as I hope has come through today, I think it's a business which has got a long way to run. The only other point I think is we are, enjoying being on the public markets. And I think the ActiveOps sort of part of participation and AIM is certainly a very good place for us to be right now. And for that reason, I'm grateful for anybody on this call who's taken the interest in the stock. So thank you all.
Fantastic, Richard. Emma, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of ActiveOps PLC, we would like to thank you for attending today's presentation, and good morning to you all.